Why Indian IPOs are crashing versus global markets, the 17% vs 58% gap explained. India just broke records with 367 IPOs in 2025, accounting for 22 to 28% of all global listings. But there's a catch. While global IPOs delivered a massive 58.3% average return, Indian IPOs struggled at just 17.5%. In this video, we deep dive into why 59% of Indian IPOs fall below their listing price within months. The valuation trap, how promoters are pricing IPOs at 2030 growth levels. Quantity versus quality, why the US and EU markets are seeing higher returns with fewer listings. The flipping culture, how retail panic selling on listing day kills long-term momentum. SME versus mainboard, why smaller issues are actually outperforming the giants. If you're an IPO investor, this is the reality check you need before applying for the next hot listing. The global return gap, 17% versus 58%. Reason 1. Excessive entry valuations. Reason 2. SME boom and quality dilution. Reason 3. Listing day profit booking. Global comparison. US tech and AI outliers. How to pick safe IPOs in 2026. 367 IPOs in just 1 year. India didn't just participate in the global IPO market, we dominated it in volume. But there is a dark side to this record. While global IPOs were handing out 58% returns, Indian investors were left holding a meager 17%. If India is the fastest growing economy, why are our IPOs failing to perform? Let's talk about the retail trap. Scene 2. The 17.5% reality check. Let's look at the cold, hard data. In 2025, the global average return for new listings was nearly 60%. In India, that number was 17.5%. That is a massive gap. Even worse, nearly 60% of our major IPOs are now trading below their listing price. You were promised a lottery ticket, but most of you were handed a falling knife. Scene 3. The greed factor, valuations. So why did this happen? Reason number 1. Greed. Promoters and investment bankers in India have become experts at pricing to perfection. They are selling you shares at 2030 valuations in 2025. They've already sucked out all the future profit before the stock even hits your Demat account. You are paying for the peak on day 1. Scene 4. Quality versus quantity. Reason 2. Quantity over quality. While the US and Europe focused on high growth, AI and deep tech sectors that saw explosive gains, India flooded the market with SMEs and traditional businesses. We had the highest volume in the world, but we lacked the high conviction gems that drive those 50% plus global averages. Scene 5. The listing day curse. Finally, the flipping culture. In India, 65% of IPOs list at a gain, but immediately, retail investors rush to exit. This massive wave of selling, combined with foreign institutional investors pulling out, destroys the stock's momentum. When everyone is looking for the exit on the first day, nobody is left to push the price higher. Scene 6. Summary. The IPO party isn't over, but the free money is. From now on, if you don't check the P/E ratio in the anchor investor list, you are just gambling. Stop following the gray market premium, GMP, and start following the balance sheet. Which IPO are you currently stuck in? Let's discuss in the comments. Subscribe for the next reality check. Question of the day. Which IPO in your portfolio is currently trading below its issue price? Are you holding for the long term or looking to exit? Join our community for daily market insights and valuation checks on every upcoming listing.